we would never have cash around just to have cash. I mean, we would never think that we should have a cash position of X percent. And frankly, I think these asset allocation things that tacticians in Wall Street put out, about 60% stocks and 30%, we think that's total nonsense. So we want to have all our money working in decent businesses, but sometimes we can't find them, or sometimes cash comes in unexpectedly, or sometimes we sell something, and we have more cash around than we would like. And more cash around than we would like means that we have 10 or 15 cents around, because we want money employed, but we'll never employ it just to employ it. And you will find us quite unhappy over time if cash just keeps building up. And I think one way or another we'll find ways to use it. You may have trouble believing this, but Charlie and I never have an opinion about the market, because it wouldn't be any good, and it might interfere with the opinions we have that are good. If we're right about a business, if we think a business is attractive, it would be very foolish for us to not take action on that because we thought something about what the market was going to do, or anything of that sort, because we just don't know. And to give up something that you do know and that is profitable for something that you don't know and won't know because of that, it doesn't make any sense to us, and it doesn't really make any difference to us. There's nothing magic. We like to put a lot of money in things that we feel strongly about, and that gets back to the diversification question. We think diversification, as practiced generally, makes very little sense for anyone that knows what they're doing. Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market, you own everything. There's nothing wrong with that. I mean, that is a perfectly sound approach for somebody who does not feel they know how to analyze businesses. If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably, because there aren't that many wonderful businesses that are understandable to a single human being in all likelihood. And to have some super wonderful business and then put money in number 30 or 35 on your list of attractiveness and forego putting more money into number 1 just strikes Charlie and me as madness. It's conventional practice, and if all you have to achieve is average, it's a confession in our view that you don't really understand the businesses that you own. On a personal portfolio basis, I own 1 stock, but it's a business I know, and it leaves me very comfortable. Do I need to own 28 stocks in order to have proper diversification? It'd be nonsense. 3 wonderful businesses. It's more than you need in this life to do very well. The average person isn't going to run into that. I mean, if you look at how the fortunes were built in this country, they weren't built out of a portfolio of 50 companies. They were built by someone who identified with a wonderful business.
Much of what is taught in modern corporate finance courses is twaddle.
Volatility does not measure risk, and the problem is that the people who have written and taught about risk do not know how to measure risk. And the nice thing about beta, which is a measure of volatility, is that it's nice and mathematical and wrong in terms of measuring risk. It's a measure of volatility, but past volatility does not determine the risk of investing. I mean, actually, take it with farmland. Here in 1980, or in the early 1980s, farms that sold for $2,000 an acre went to $600 an acre. I bought one of them when the banking and farm crash took place, and the beta of farms shot way up. And according to standard economic theory, or market theory, I was buying a much more risky asset at $600 an acre than the same farm was at $2,000 an acre. Now, people, because farmland doesn't trade often and prices don't get recorded, they would regard that as nonsense, that my purchase at $600 an acre of the same farm that sold for $2,000 an acre a few years ago was riskier. But in stocks, because the prices jiggle around every minute, and because it lets the people who teach finance use the mathematics they've learned, they have, in effect, they would explain this away a little more technically, but they have, in effect, translated past volatility in terms of all kinds of measures of risk. And it's nonsense. Risk comes from the nature of certain kinds of businesses. It can be risky to be in some businesses just by the simple economics of the type of business you're in. And it comes from not knowing what you're doing. And, it is, if you understand
the economics of the business in which you are engaged, and you know the people with whom you're doing business, and you know the price you pay and is sensible, you don't run any real risk. And I don't think Charlie and I, certainly at Berkshire, I don't think we've ever had a permanent loss in marketable securities that was, what, 1% maybe? 0.5% of net worth. I made a terrible mistake in buying Dexter Shoe, which cost us a significantly more than 1% of net worth, where I bought an entire business then. But I was wrong about the business. It had nothing to do with the volatility of shoe prices or leather or anything else. It just was wrong. But in terms of marketable securities, I cannot recall a case where we've lost. I mean, we've done a lot of things in securities that had a very high beta. We've done a lot of things in securities that had a low beta. It just, the whole development of volatility as a measure of risk, we've never found a way for it to be useful to us.
Both corporate finance and investment management courses, as taught in the major universities, we would argue it's at least 50% twaddle. Yet these people have very high IQs. One of the reasons we've been able to do pretty well is that we early recognized that very smart people do very dumb things, and we tried to figure out why. And we also wanted to know who, so we could avoid them.
It's a temperamental quality, not an intellectual quality. You don't need tons of IQ in this business. I mean, you have to have enough IQ to get from here to downtown Omaha, but you do not have to be able to play three-dimensional chess or be in the top leagues in terms of bridge playing or something of the sort. You need a stable personality. You need a temperament that neither derives great pleasure from being with the crowd or against the crowd, because this is not a business where you take polls. It's a business where you think. And Ben Graham would say that you're not right or wrong because 1,000 people agree with you, and you're not right or wrong because 1,000 people disagree with you. You're right because your facts and your reasoning are right.
By far the best investment you can make is in yourself. I mean, for example, communication skills. I tell the students that come that they're going to graduate schools and business, and they're learning all these complicated formulas and all that. If they just learn to communicate better, and both in writing and in person, they increase their value at least 50%. If you can't communicate, somebody says, it's like winking at a girl in the dark. Nothing happens, basically. And you have to be able to get forth your ideas. And that's relatively easy. I did it myself with the Dale Carnegie course. Some people wish I'd taken a shorter course now in terms of my talking later on. But it's just hugely important. And if you invest in yourself, nobody can take it away from you. If I gave you a car, and it'd be the only car you get in the rest of your life, you take care of it like you can't believe. Any scratch, you'd fix that moment. You read the owner's manual. You keep it garage and do all these things. And you get exactly one mind and one body in this world. And you can't start taking care of it when you're 50. By that time, you'll have rusted out if you haven't done anything. So you should really make sure that you just remember that you just got one mind and body to get through life with and to do the most with it.
We think the best way to minimize risk is to think. And the idea that you have, you say, I've got 60% in stocks and 40% in bonds, and then have a big announcement, now we're moving it to 65-35 as some strategists or whatever they call them in Wall Street do. I mean, that has to be pure nonsense. I mean, 60-40 or 65-30, it just doesn't make any sense. I mean, what you ought to do is have your default position is always short-term instruments, and whenever you see anything intelligent to do, you should do it, and you shouldn't be trying to match up with some goal like that. I found it entertaining. I was just reading yesterday an article, I think it was, about the two fellows at Google and all of the problems they're going to have because they're each going to get a few $1 billion. And I mean, it was. I mean, I wanted to send a sympathy card. I almost went down a Hallmark store because this article went on. They've got this terrible problem and that terrible problem, and they're going to need lawyers and they're going to need financial lawyers. They don't need anybody. Those guys are smarter than the people that are coming to them, and they do not have a big problem. And they're very capable of thinking it through themselves. The people that have the problem are the people who want to sell their services to them and are going to have to convince them that they have a problem. But so much of what you see when you talk about asset allocation or something, it's just merchandising. It's a way to make you think that if you don't know how to determine whether it should be 60-40 or 65-35, that you need these people. And you don't need them at all in investing. I mean, and most of the professionals that tell you you're going to get in great trouble unless you listen to them and sign up for their services, they're good at selling. But it's what my brother-in-law, former brother-in-law that worked at the stockyards used to say, was that people would bring in cattle or something, and I'd say to them, how do you get the farmer to employ you to sell the Swift or Armor or Cudahy instead of the guy right next to you? I mean, it's a cow is a cow, and Armor's going to buy it the same way. And he gave me this disgusted look, and he said, Warren, it's not how you sell them, it's how you tell them. Well, there's a lot of that in Wall Street.
Yeah, people have always had this craving to know the future. The king used to hire the magician or the forecaster, and he'd look in sheep guts or something for an answer as to how to handle the next war. And so there's always been a market for people who reported to know the future based on their expertise. And there's a lot of that still going on. It's just as crazy as when the king was hiring the forecaster who looked at the sheep guts. And people have an economic incentive to sell some nostrum. It can be sold over and over and over again. The really interesting figures are when you combine the underperformance of the market, say by the mutual fund industry, which is probably a couple of points per annum, that understates it. Now, if you take all of the investors in the mutual funds who are constantly whipsawing from one fund to another by a bunch of brokers who want commissions, now you take a subnormal performance and it goes down another 3 or 4 percentage points due to the shuffling of the mutual fund investments. So the poor guy in the general public is getting a terrible result from contacting the experts. And these guys are heading the scout troop and the community chess drive and are locally reputable people. I think it's disgusting. It's much better to make a living by being part of a system that delivers value to the people who are buying the product. But nobody refrains from creating gambling casinos or something on my theory. If it'll work to make money, well, we tend to do it in this country.
Desire of people to gamble, and they gamble in stocks, incidentally, too. Day trading, I would say, very often came very close to gambling as defined. But people like to gamble. I mean, it's if the Super Bowl is on, or even, better yet, if a terribly boring football game is on, but you don't have anything to do, and you're sitting there with somebody else, you're probably going to enjoy the game more if you bet a few bucks on it one way or the other. The human propensity to gamble is huge. Now, when it was legalized only pretty much in Nevada, you had to go to some distance or break some laws to do any serious gambling. But as the states learned to, what a great source of revenue it was, they gradually made it easier and easier and easier for people to gamble. And believe me, the easier it's made, the more people will gamble. I mean, my children are here, and 40 years ago, I bought a slot machine and I put it up on our 3rd floor. And I could give my kids any allowance they wanted as long as it was in dimes. I mean, I had it all back by nightfall. I thought it would be a good lesson for them. And now, they weren't going to Las Vegas to do it, but believe me, when it was on the 3rd floor, they could find it, and my payout ratio was terrible, too, but that's the kind of father I was. But gambling, people are always going to want to do it. And for that reason, I particularly think that to quite an extent, gambling is a tax on ignorance. I mean, if you want to tax the ignorant, people who will do things with the odds against them, you just put it in, and guys like me don't have to pay taxes. And I really don't. I find it kind of socially revolting when a government preys on the weaknesses of its citizenry rather than acts to serve them. And believe me, when a government sticks,
I've really said that growth and value, they're indistinguishable. They're part of the same equation, or really growth is part of the value equation. So our position is that there is no such thing as growth stocks or value stocks, the way Wall Street generally portrays them as being contrasting asset classes. Growth usually is a positive for value, but only when it means that by adding capital now, you add more cash availability later on at a rate that's considerably higher than the current rate of interest. So we calculate into any business we buy what we expect to have happen in terms of the cash that's going to come out of it or the cash that's going to go into it. So if you tell me that that you own a business that's going to grow to the sky, and isn't that wonderful? I don't know whether it's wonderful or not until I know what the economics are of that growth, how much you have to put in today and how much you will reap from putting that in today later on. And the classic case, again, is the airline business. The airline business has been a growth business ever since, that Orville took off. But the growth has been the worst thing that happened to it. It's been great for the American public. But the growth has been a curse in the airline business because more and more capital has been put into the business at inadequate returns. Now, growth is wonderful at See's Candy because it requires relatively little incremental investment to sell more pounds of candy. So it's growth, and I've discussed this in some of the annual reports. Growth is a part of the equation, but anybody that tells you ought to have your money in growth stocks or value stocks really does not understand investing. Other than that, they're terrific people. The real point is that we're trying to put out capital now to get more capital, or money. We're trying to put out cash now to get more cash back later on. And if you do that, the business grows, obviously, and you can call that value or you can call it growth, but they're not two different categories. And I just cringe when I hear people talk about now it's time to move from growth stocks to value stocks or something like that, because it just doesn't make any sense.
In general terms, unless you find the prices of a great company really offensive, if you feel you've identified it, and by definition, a great company is one that's going to remain great for 30 years. If it's going to be a great company for 3 years, it ain't a great company. I mean, so you really want to go along with the idea of something that if you were going to take a trip for 20 years, you wouldn't feel bad leaving the money in with no orders with your broker and no power of attorney or anything, and you just go on the trip and you come back and it's going to be a terribly strong company. I think it's better just to own them. I mean, we could attempt to buy and sell some of the things that we own that we think are fine businesses, but they're too hard to find. We found See's Candy in 1972, where we find here and there we get the opportunity to do something, but they're too hard to find. So to sit there and hope that you buy them in the throes of some panic, that you sort of take the attitude of a mortician, waiting for a flu epidemic or something. I mean, I'm not sure that will be a great technique. That's a lot to count on, and if you start with the Dow at X and you think it's too high, when it goes to 90% of X, do you buy? Well, if it does and it goes to 50% of X, it gets, you never get the benefit of those extremes anyway, unless you just come into some accidental sum of money at some time. So I think the main thing to do is find wonderful businesses. So we've had our share of flu epidemics, but you don't want to spend your life waiting around for them.
When people said cash is king a year ago, I mean, that's crazy. I mean, cash wasn't producing anything, and it was sure to go down in value over time. And then you always want to be sure you have enough. I mean, it's like oxygen. You want to be sure it's around, but you don't need to have excessive amounts of it around.
You can't really fail at it unless you buy the wrong stock or just get excited at the wrong time. And I would like to just spend just a couple of minutes giving you a little perspective on how you might think about investments as opposed to the tendency to focus on what's happening today or even this minute as you go through. And to help me in doing that, I'd like to go back through a little personal history, and we will start. I have here a New York Times of March 12th, 1942. I'm a little behind on my reading. And if you go back to that time, it was just about 3 months since we got involved in a war which we were losing at that point. The newspaper headlines were filled with bad news from the Pacific, and I've taken just a couple of the headlines from the days preceding March 11th, which I'll explain. It's kind of a momentous day for me. And so you can see these headlines. We've got slide 2 up there, I believe. we were in trouble, big trouble, in the Pacific. It was only going to be a couple months later that the Philippines fell, but here we were getting bad news. We might go to slide 3 for March 9th. I hope you can read the headlines anyway. The price of the paper is 3 cents, incidentally. Let's see, we've got March 10th up there, a slide. When I get to this advanced technology of slides, I want to make sure I'm showing you the same thing that I'm seeing in front of me. So anyway, on March 10th, when again, the news was bad. Full clearing path to Australia. And it was like, the stock market had been reflecting this. And I'd been watching a stock called City Service Preferred Stock, which had sold at $84 the previous year. It had sold at $55 the year before, early in January, 2 months earlier. And now it was down to $40 on March 10th. So that night, despite these headlines, I said to my dad, I think I'd like to pull the trigger. And I'd like you to buy me three shares of City Service Preferred the next day. And that was all I had. I mean, that was my capital accumulated over the previous 5 years or thereabouts. And so my dad the next morning bought 3 shares. Well, let's take a look at what happened the next day. Let's go to the next slide, please. And it was not a good day. The stock market, the Dow Jones Industrials broke 100 on the downside. Now, they were down 2.28%, as you see, but that was the equivalent of about a 500-point drop now. So I'm in school wondering what is going on, of course. Incidentally, you'll see on the left side of the chart, the New York Times put the Dow Jones Industrial Average below all the averages they calculated. They had their own averages, which have since disappeared, but the Dow Jones has continued. So the next day, we can go to the next slide, and you will see what happened. The stock that was at 39, my dad bought my stock right away in the morning because I'd asked him to, my 3 shares. And so I paid the high for the day. That 38 and a quarter was my tick, which is the high for day. And by the end of the day, it was down to 37, which was really kind of characteristic of my timing in stocks that was going to appear in future years. But it was on what was then called the New York Curb Exchange, then became the American Stock Exchange. But things, even though the war until the Battle of Midway looked very bad, and if you'll turn to the next slide, please, you'll see that the stock did rather well. You can see where I bought it, 38 and a quarter. And then the stock went on actually to eventually be called by the City Service Company for over $200 a share. But this is not a happy story, because if you go to the next page, you will see that well, as they always say, it seemed like a good idea at the time. So I sold. I made $5 on it. It was again typical of behavior. But when you watch it go down to 27, it looked pretty good to get that profit. Well, what's the point of all this? Well, we can leave behind the City Service story, and I would like you to again imagine yourself back on March 11th of 1942. And as I say, things were looking bad in the European theater as well as what was going on in the Pacific. But everybody in this country knew America was going to win the war. I mean, it was, we'd gotten blindsided, but we were going to win the war, and we knew that the American system had been working well since 1776. So if you'll turn to the next slide, I'd like you to imagine that at that time, you had invested $10,000 and you'd put that money in an index fund. We didn't have index funds then, but you in effect bought the S&P 500. Now I would like you to think a while, and do not change the slide here for a minute. I'd like you to think about how much that $10,000 would now be worth if you just had one basic premise, just like in buying a farm, you buy it to hold throughout your lifetime and you look to the output of the farm to determine whether you made a wise investment. You look to the output of the apartment house to decide whether you made a wise investment if you buy an small apartment house to hold for your life. And let's say instead you decided to put the $10,000 in and hold a piece of American business and never look at another stock quote, never listen to another person give you advice or anything on the sort. I want you to think how much money you might have now. And now that you've got a number in your head, let's go to the next slide and we'll get the answer. You'd have $51 million and you wouldn't have had to do anything. You wouldn't have to understand accounting. You wouldn't have to look at your quotations every day like I did that first day. I'd already lost $3.75 by the time I came home from school. All you had to do was figure that America was going to do well over time, that we would overcome the current difficulties, and that if America did well, American business would do well. You didn't have to pick out winning stocks. You didn't have to pick out a winning time or anything of the sort. You basically just had to make one investment decision in your life. And that wasn't the only time to do it. I mean, I could go back and pick other times that would work out to even greater gains. But as you listen to the questions and answers we give today, just remember that the overriding question is, how is American business going to do over your investing lifetime? I would like to make one other comment because it's a little bit interesting. Let's say you'd taken that $10,000 and you'd listen to the prophets of doom and gloom around you, and you'll get that constantly throughout your life. And instead you'd use the $10,000 to buy gold. Now for your $10,000, you would have been able to buy about 300 ounces of gold. And while the businesses were reinvesting in more plants and new inventions came along, you would go down every year look in your safe deposit box, and you'd have your 300 ounces of gold, and you could look at it, and you could fondle it, and you could, whatever you wanted to do with it. But it didn't produce anything. It was never going to produce anything. And what would you have today? You would have 300 ounces of gold, just like you had in March of 1942, and it would be worth approximately $400,000. So if you decided to go with a non-productive asset, gold, instead of a productive asset, which actually was earning more money and reinvesting and paying dividends and maybe purchasing stock, whatever it might be, you would now have over 100 times the value of what you would have had with a non-productive asset. In other words, for every dollar you have made in American business, you'd have less than a penny of gain by buying in the store value, which people tell you to run to every time you get scared by the headlines or something of the sort. It's just remarkable to me that we have operated in this country with the greatest tailwind at our back that you can imagine. It's an investor's haven. You can't really fail at it unless you buy the wrong stock or just get excited at the wrong time. But if you own a cross-section of America and you put your money in consistently over the years, there's no comparison against owning something that's going to produce nothing. And frankly, there's no comparison with trying to jump in and out of stocks and pay investment advisors. If you'd followed my advice, incidentally, or this retrospective advice, which is always so easy to give, if you'd follow that, of course, there's one problem about it. Your friendly stockbroker would have starved to death. I mean, and you could have gone to the funeral to atone for their fate. But the truth is, you would have been better off doing this than a very, very, very high percentage of investment professionals have done, or people have done that are active. It's very hard to move around successfully and beat really what can be done with a very relaxed philosophy. And you do not have to know as much about accounting or stock market terminology or whatever else it may be, or what the Fed is going to do next time and whether it's going to raise rates 3 times or 4 times or 2 times. None of that counts at all, really, in a lifetime of investing. What counts is having a philosophy that you stick with, that you understand why you're in it, and then you forget about doing things that you don't know how to do. These people had one thing in common. They knew they had it in themselves. They knew they could be something beyond where they were. They were willing to put their time, their energies to better themselves. What you really could do with more skills, it's just remarkable. So I would like to just tell you a couple of short stories, and we'll draw maybe a couple of lessons from them. I would like to tell you of 2 women that each sold a business to Berkshire Hathaway, to me actually, for many, many, many millions of dollars. Both of them started with $2,500. By a coincidence, it was the exact same amount. It was everything they had in the world. And one of them was a woman who landed in Seattle in 1917, couldn't speak a word of English, had a tag around her neck. The tag said Fort Dodge, Iowa. The Red Cross got her to Fort Dodge, where she was reunited with her husband who had come to the country a couple of years earlier. And she lived in Fort Dodge for 2 years. And as she put it, she felt like a dummy. She couldn't pick up the language. She couldn't learn a word. And so she and her husband decided to move to Omaha. So they came to Omaha in 1919. And there she found a small colony of Russian Jews, so she started feeling more at home. And then as her oldest daughter went to school, she would come home, this daughter, Frances, and she would teach her mother the words she'd learned in school that day. And this woman, Rose Blumpkin, spent 20 years saving money, bringing first her siblings over, her mother and father, $50 at a time. She sold used clothing to do it. She had 4 children during this period. And by 1937, after 20 years, she'd saved $2,500. She went to Chicago and she bought what she could of furniture. Her dream had always been to open a furniture store. And this woman who had never gone to school one day in her life, with $2,500, but with the same spirit that the people in this room had about having a dream and working to accomplish that dream, she built a business which she sold to me in 1983 for $60 million approximately, and which did $1.5 billion worth of business last year. The 4th generation is working in that business. This woman, Rose Blumpkin, she worked for me until she was 103. And then she retired and she died the next year, which is a lesson to all of Berkshire's managers that premature retirement, you can't tell what's going to happen. But Mrs. B, with her $2,500, one further fact about her, she could not read or write. And she went into a furniture business, and she didn't bring anything unique in furniture, but she brought a determination to succeed. She knew she could outwork anyone else. She knew she cared about her customers. She worked at very low gross margins, but she built this incredible business. And I saw one other woman who did a similar thing with $2,500. I paid her hundreds of millions of dollars for her business. So I decided to go to the source and get these people before, I don't want you guys coming around to me asking me hundreds of millions of dollars. I'd like to join in with you much earlier. So I've followed this group. And today I'd like to tell you about one other small business person. This person, I went to buy his business from him, and he
turned me down, which was very wise. But this was a fellow who was born about 8 years before I was. He was born in 1922. We'll call him Jack, lived in the Midwest. He was a pretty good athlete, didn't like school much. And I'm going to tell you one thing early in the story. Maybe you can figure out who the guy was. The company he built hires more college graduates each year than any other company in the United States. And this fellow, who was destined for this but did not know it, Jack, went to college for a year and then dropped out. He really wasn't that interested in school. And the year he dropped out was 1941. And when the United States became under attack, he went down to the Army Air Force recruiting station, volunteered, and they turned him down because he had hay fever. So he went over to the Navy and again volunteered, and they took him. They put him on an aircraft carrier. He flew small flight airplanes during World War II, got 2 distinguished flying crosses from the Navy, and then he came back to the Midwest. So now we've got a young guy. Probably by this time he would be 23 or 24 years old. And the interesting thing is, he got back to the Midwest, and he actually kind of went from one job to another for a short period of, or not such a short period of time. And he finally became a used car salesman at a Cadillac dealership in St. Louis, Missouri. And at age 35, having moved up in the organization, the sales organization, he said to his boss, "Could I go into car leasing business with you?" The boss said, "Well, if you'll cut your salary in half and you'll come up with," I think it was $25,000, which he borrowed, "we can become partners in a car leasing company." So my friend Jack started at age 35 in the car leasing business. And he had 7 cars. It was pretty slow. In fact, one of the things he did was whenever the phone rang, he let it ring 3 or 4 times so people would think that he was very busy answering other phones. And of course, it was the only call he was going to get all day. So his first venture was okay, but it wasn't really going to go anyplace. And there's a lesson in this for all of us. At age 40, he decided, with 17 vehicles, 17 cars, he was going to go into competition in the rent-a-car business. So now he's taking on Hertz and Avis and National and people like that who have hundreds and hundreds of thousands of cars. And he's got 17 cars, and his cars aren't any different than theirs. I mean, he's buying them from General Motors or Ford or Chrysler. And he can't get the airport locations. Those companies have them all sold up. But he was determined that he would basically offer the customer, can't offer him a different car, but he can offer them friendlier service than they've ever seen. And so he started a company. He named it after the battleship that he'd flown from in the Pacific, which was the USS Enterprise. And he died about a year and a half ago. But when he died, his rent-a-car company, starting with those 17 cars, was worth more than Hertz and Avis and all the rest of the rental cars put together. The man's name was Jack Taylor, and his son, Andy Taylor, is a good friend of mine, runs the business now. A grandchild is in the business. There'll probably be a 4th generation along the line. So this man, in the United States, he didn't invent artificial intelligence. You know, he didn't do anything that, just like Mrs. B selling furniture, I mean, that any one of us could have entered those businesses. But he lived by the creed, basically, of delighting his customers and working with people and establishing the relationship with them so that they in turn would want to delight the customers. He couldn't go out there and take care of every rental car possibility, but he learned how to project himself and his attitude toward his fellow man and his desire, to make a friend out of every customer. He managed to take very ordinary cars
and turned them into this extraordinary business from virtually nothing. And it illustrates several points. One is you don't necessarily get it right exactly right the first time. I mean, the car leasing business, basically you were competing on the cost of money to finance cars. And it's very hard to delight a customer when you just give them the car and tell them to send you a monthly check for 5 years and you'll be back at that time. So his talents were being wasted basically in that business. But at the age of 40, with all of that experience behind him, he found the golden key. He took a very ordinary business and turned it into an absolutely extraordinary operation, just like Mrs. B or Rose Blumpkin did with furniture. And he didn't worry about whether the Federal Reserve was going to tighten or ease. He didn't worry about whether the stock market was up or down yesterday. He didn't worry about the things he couldn't change, but he did focus on the one thing he could change, and that was the customer's experience. And I have seen the one that got away, Enterprise. I went down to Florida and tried to talk him into selling to Berkshire, and he was smart enough not to do it. Probably the value of the company has quadrupled since I made that visit. But he was smart enough to see that he would find that business. Henry Ford, as you may know, failed twice before he started the Ford Motor Company in 1903. I mean, the test isn't whether you get the greatest business idea in the world the first time out. The test is whether you keep learning as you go along what your strengths are and what you can do for your customers, what you can bring especially to the party. And to do that, you need the education that I know you've received through 10,000 small businesses, but you need a genuine desire day in, day out to delight the customer. I've never seen a business, and I've seen a lot of businesses, but I've never seen one that delights the customer that doesn't succeed. I mean, what you want is that customer the next day when they think, do I want to rent a car or do I want to buy some furniture? What goes through their mind? It's the place where they've had a great experience. I don't know what I paid for this tie. Actually, probably if somebody gave it to me, but for the purposes of this speech, I will say I have no idea. But or the shirt I'm wearing, but I do know. I will remember how I was treated when I bought it. I mean, you long forget about the price, but you never forget whether you had a good experience or a poor experience with the purchase experience. And you'll have a hard time finding a person that's had a wonderful experience, a delighted experience in purchasing anything that isn't going to come back. And similarly, if the memory is of rudeness, indifference, whatever it may be, they're never going to come back. And as a small business owner, and as you grow, you have to not only be able to project that interest in people's well-being, in delighting them yourself, but you have to do it through other people. And you won't be able to do it through people who themselves do not feel they're being fairly treated, that their views aren't appropriately considered. So you really do have to learn to multiply yourself through other people. And I advise the young people to come to Omaha. We have a number of classes. The key is to, certainly in terms of your personal life, the most important decision you'll make is the spouse that most of you will likely have. And it's very important to surround yourself with people that are better than you are. You are going to move in the direction of the people you associate with. So you constantly, I've been enormously lucky in that respect. I mean, I've just had teachers and friends and a spouse that really was a better person than I was. And I had enough sense to learn from these people that life went better if you behave better yourself. It took a while. So I advise you to seek out, as your partner in business, your partner in life, whatever it may be, look for the people that actually are examples to you rather than somebody that you think you need to straighten out yourself. And simple rules like that, delighting customers, working through other people, associating with people that will cause you to move in a better path than you might otherwise have, they will take you so far in life that it's hard to believe. I mean, they took Rose Blumpkin without being able to speak a word of English, couldn't read or write, and they took her to what is now a $1.5 billion business. And incidentally, there's been no money put in it since the $2,500. That's been the total capital paid into the Nebraska Furniture Mart. And I think if you looked at Enterprise, I don't know their books the same way, but my guess is that very little equity capital has been added to Enterprise over the years. The business built on itself. So I want to tell you, I admire this group enormously. When I met Dr. Mello's class on September 22nd, 8 years ago, I was thrilled. And I admire people that are doing what you have done. Working hard at your job at the same time, you took on an added, really, a lot of hard work to further your skills. 99% graduate. I mean, that's a mind-blowing statistic. And I'm looking at 2,200 people here who I admire. I'm cheering for you, and I can tell you the best is yet to come. Thank you.
Why have you advised your wife to invest in index funds after your death rather than Berkshire Hathaway? I believe Munger has counseled his offspring to, quote, not be so dumb as to sell.
She won't be selling any Berkshire to buy the index funds. All of my Berkshire, every single share, will go to philanthropy. So I don't even regard myself as owning Berkshire. Basically, it's committed. And so far about 40% has already been distributed. So the question is, somebody who is not an investment professional will be, I hope, reasonably elderly by the time that the estate gets settled. And what is the best investment, meaning one that there would be less worry of any kind connected with, and less people coming around and saying, why don't you sell this and do something else and all those things. She's going to have more money than she needs. And the big thing then you want is money not to be a problem. And there will be no way that if she holds the S&P, or virtually no way, absent something happened with weapons of mass destruction, but virtually no way that she'll have all the money that she possibly can use. She'll have a little liquid money so that if stocks are down tremendously at some point, or they close the stock exchange for a while, anything like that, she'll still feel that she's got plenty of money. And the object is not to maximize. It doesn't make any difference whether the amount she gets doubles or triples or anything of the sort. The important thing is that she never worries about money the rest of her life. And I had an Aunt Katie here in Omaha, who Charlie knew well, and worked for her husband, as did I. And she worked very hard all her life and had lived in a house she paid, $8,000 for, 45th and Hickory, all her life. And because she was in Berkshire, she lived in 97. She ended up with, a few $100 million. And she would write me a letter every 4 or 5 months, and she said, "Dear Warren, I hate to bother you, but am I going to run out of money?" And and I would write her back, and I'd say, "Dear Katie, it's a good question, because if you live 986 years, you're going to run out of money." And then about 4 or 5 months later, she'd write me the same letter again. And I have seen, there's no way in the world, if you've got plenty of money, that it should become a minus in your life. And there will be people, if you've got a lot of money, that come around with various suggestions for you, sometimes well-meaning, sometimes not so well-meaning. So if you've got something that's certain to deliver, it was all in Berkshire, they'd say, well, if Warren was alive today, he would be telling you to do this. I just don't want anybody to go through that. And the S&P will be I think actually what I'm suggesting is what a very high percentage of people should do something like that. And I don't think they will have I think there's a chance they won't have as much peace of mind if they own one stock and they've got neighbors and friends and relatives that are trying to do some, like I say, sometimes well-intentioned, sometimes otherwise, to do something else. And so I think it's a policy that will get a good result and is likely to stick. Charlie?
Well, as Becky said, the Mungers are different. I want them to hold the Berkshire.
Well, I want to hold the Berkshire too.
No, I don't like the Berkshire. I recognize the logic of the fact that S&P algorithm is very hard to beat. In a diversified portfolio of big companies, it's all but impossible for most people. But, I'm just more comfortable with the Berkshire.
Well, it's the family business.
Yeah.
But I've seen too many people as they get older, particularly being susceptible and just having to listen to the arguments of people coming along.
Well, if you're going to protect your heirs from the stupidity of others, you may have some good system, but I'm not much interested in that subject.
Okay.
We've both had a fair amount of experience in real estate, and Charlie made his early money in real estate. The second point is the more important point. Real estate is not a commodity, but I think it tends to be more accurately priced, particularly developed real estate, more accurately priced most of the time. Now, during the RTC period, when you had huge amounts of transactions and you had an owner that didn't want to be an owner in a very big way, and they didn't know what the hell they owned and all of that sort of thing. I mean, you had a lot of mispricing then, and I know a few people in this room that made a lot of money off of that. But under most conditions, it's hard to find real estate that's really mispriced. I mean, when I look at the transactions that REITs engage in currently, and you get a lot of information on that sort of thing, they're very similar, but it's a competitive world, and they all know about what a Class A office building in Chicago or wherever it may be is going to produce. At least they may all be wrong, as it turns out, because of some unusual events, but it's hard to argue with the current conventional wisdom most of the time in the real estate world. But occasionally there have been some, there could be big opportunities in the field, but if they exist, it will certainly be because there'll be a lot of chaos in real estate financing for one reason or another. We've done some real estate financing, and you have to have the money shut off to quite a degree, probably, to get any big mispricing across the board. Charlie?
Yeah, we don't have any competitive advantage over experienced real estate investors in the field, and we wouldn't have if we were operating with our own money as a partnership. And if you operate as a corporation such as ours, which is taxable under Chapter C of the Internal Revenue Code, you've got a whole layer of corporate taxes between the real estate income and the use of the income by the people who own the real estate. So by its nature, real estate tends to be a very lousy investment for people who are taxed under Subchapter C of the code relating to corporations. So the combination of having it generally a lousy activity for people with our tax structure and having no special competence in the field means that we spend almost no time thinking about anything in real estate, and then such real estate as we've actually done, like holding surplus real estate and trying to sell it off, I'd say we have a poor record at.
Yeah, C Corps really it doesn't make any sense. I mean, I know there are C Corps around that are in real estate, but there are other structures that are more attractive. There really aren't other structures. I mean, Lloyd's is an attempt at it to some degree, but there aren't other structures that work well for big insurance companies. You can't have a Walmart very well that does not exist in a C Corp. So they are not subject to S Corp or partnership competition that determines the returns on capital in the discount store field. But if you're competing with equivalent of S Corps, REITs, or partnerships or individuals, you've just got an economic disadvantage as a C Corp, which is, for those of you who don't love reading the Internal Revenue Code. It's just a standard vanilla corporation that you think of, all of the Dow Jones companies, all of the S&P companies, and so on. And as Charlie says, it's unlikely that the disadvantage of our structure, combined with the competitive nature of people with better structures buying those kinds of assets, will ever lead to anything really interesting. Although I would say that we missed the boat to some extent during the RTC days. I mean, it was a sufficiently inefficient market at that time, and there was a lack of financing that we could have made a lot of money if we had been geared up for it at that time. We actually had a few transactions that were pretty interesting, but nothing that was significant in relation to our total capital.
We thought significantly about buying the Irvine Corporation when it became available. So that's the only big one I can remember that we seriously thought about.
Yeah, that was in 1977 or so.
Way back.
Yeah, Mobil Oil was interested in, Don Brennan ended up putting together a group for it. But, that kind of thing could conceivably happen, but it's unlikely.
Warren Buffett is the greatest investor of all time. If you had put $1,000 into his investment company when it started, it would be worth over $30 million today. Such returns can seem unrealistic, but how did Buffett actually do it? The answer is, he understands what most people don't, and is sticking to a few key principles that you can implement in your everyday life. Keep watching, because by the end of this video, you will learn all of them.
We look for three things when we hire people. We look for intelligence, we look for initiative or energy, and we look for integrity. And if they don't have the latter, the first two will kill you. Because if you're going to get somebody without integrity, you want them lazy and dumb. I mean, you don't want them smart and energetic. So the answer is that investors behave in very human ways, which is they get very excited during bull markets, and they look in the rearview mirror and they say, I made money last year, I'm going to make more money this year, so this time I'll borrow, or the neighbor says, I wasn't in last year when that neighbor was dumber than I am, made a lot of money, so I'm going to go in this year. So they're always looking in the rearview mirror. And when they look in the rearview mirror and they see a lot of money having been made in the last few years, they plow in and they just push and push and push on prices. And when they look in the rearview mirror and they see no money having been made, they just say, this is a lousy place to be. So they don't care what's going on in the underlying business. And it's astounding, but that makes for huge opportunity, just huge opportunity. I've been taught by Ben Graham to buy things on a quantitative basis. Look around for things that are cheap. And that I was taught that, we'll say in 1949 or 50. It made a big impression on me. So I went around looking for what I call used cigar butts of stocks. And the cigar butt approach to buying stocks is that you walk down the street and you're looking around for cigar butts, and you find this on the street, this terrible looking, soggy, ugly looking cigar, one puff left in it. But you pick it up and you get your one puff. Disgusting, you throw it away, but it's free. I mean, it's cheap. And then you look around for another soggy, one puff cigarette. Well, that's what I did for years. It's a mistake. Although you can make money doing it, but you can't make it with big money. It's so much easier just to buy wonderful businesses. So now I would rather buy a wonderful business at a fair price than a fair business at a wonderful price. But I have an old-fashioned belief that I can only should expect to make money in things that I understand. And when I say understand, I don't mean understand, what the product does or anything like that. I mean understand what the economics of the business are likely to look like 10 years from now or 20 years from now. I know in general what the economics of, say, Wrigley chewing gum will look like 10 years from now. The internet isn't going to change the way people chew gum. It isn't going to change which gum they chew. If you own the chewing gum market in a big way, and you've got Double Mint and Spearmint and Juicy Fruit, those brands will be there 10 years from now. So I can't pinpoint exactly what the numbers are going to look like on Wrigley, but I'm not going to be way off if I try to look forward on something like that. That evaluating that company is within what I call my circle of competence. I understand what they do, I understand the economics of it, I understand the competitive aspects of the business. But the biggest mistakes we've made by far, biggest mistakes I've made by far are mistakes of omission and not commission. I mean, it's the things I knew enough to do, they were within my circle of competence, and I was sucking my thumb. And that is really, those are the ones that hurt. They don't show up anyplace. I probably cost Berkshire at least
$5 billion, for example, by sucking my thumb 20 years ago or close to it when Fannie Mae was having some troubles, and we could have bought the whole company for practically nothing. And I don't worry about that if it's Microsoft because I don't know it. Microsoft isn't in my circle of competence. And so I don't have any reason to think I'm entitled to make money out of Microsoft or out of cocoa beans or whatever. But I did know enough to understand Fannie Mae, and I blew it. And that never shows up under conventional accounting. But I know the cost of it. I know. I passed it up. And those are the big, big mistakes. And I've had plenty of them. Unless I tell you about them in the annual report, and I resist the temptation sometimes, unless I tell you about them in the annual report, you're not going to know it because it doesn't show up under conventional accounting. But omission is way bigger than commission. There's big opportunities in life have to be seized. We don't do very many things, but when we get the chance to do something that's right and big, we've got to do it. And even to do it in a small scale is just as big a mistake almost as not doing it at all. I mean, you've really got to grab them when they come. Because you're not going to get 500 great opportunities. You would be better off if when you got out of school here, you got a punch card with 20 punches on it. And every financial decision you made, you used up a punch. You'd get very rich because you'd think through very hard each one. I mean, you went to a cocktail party and somebody talked about a company, you didn't even understand what they did or couldn't pronounce the name, but they made some money last week and another one like it. You wouldn't buy it if you only had 20 punches on that card. In terms of our wholly owned businesses, we're not going to sell no matter how much anybody offers us for them. I mean, if somebody offers us 3 times what something is worth at See's Candy, the Buffalo News, Borsheim's, whatever it may be, we're not going to sell it. I may be wrong in having that approach. I know I'm not wrong if I owned 100% of Berkshire because that's the way I want to live my life. I've got all the money I could possibly need. It just amounts to a change in the newspaper story on my obituary and the amount of money that the foundation has. And to break off relationships with people I like and people that have joined me because they think it's a permanent home, to do that simply because somebody waves a big check at me would be like selling one of my children because somebody waved a big check. So I won't do that. And I want to tell my partners I won't do it so that they're not disappointed in me. More and more with certain stocks, we've got that approach. Now, if we were chronically short of funds and had all kinds of opportunities coming, we might have a somewhat different approach. But our inclination is not to sell things unless we get really discouraged perhaps with the management, or we think the economic characteristics of the business change in a big way. I mean, and that happens. So, but we're not going to sell simply because it looks too high, in all likelihood. So now let's go over here.
Hello, Mr. Buffett. I got 2 short questions. One is, how do you find intrinsic value in a company?
Well, intrinsic value is the number that if you were all knowing about the future and could predict all the cash that a business would give you between now and Judgment Day, discounted at the proper discount rate, that number is what the intrinsic value of a business is. In other words, the only reason for making an investment and laying out money now is to get more money later on, right? That's what investing is all about. Now, when you look at a bond, assuming it's the United States government bond, it's very easy to tell how much you're going to get back. It says it right on the bond. It says when you get the interest payments, it says when you get the principal. So it's very easy to figure out the value of a bond. It can change tomorrow if interest rates change, but the cash flows are printed on the bond. The cash flows aren't printed on a stock certificate. That's the job of the analyst, is to print out, change that stock certificate, which represents an interest in the business, and change that into a bond and say, this is what I think it's going to pay out in the future. When we buy, some new machine for Shaw to make carpet, that's what we're thinking about, obviously, and you all learn that in business school. But it's the same thing for a big business. If you buy Coca-Cola today, the company is selling for about $110 to $15 billion in the market. The question is, if you had 110 or 15 billion, you wouldn't be listening to me, but I'd be listening to you instead. But the question is, would you lay it out today to get what the Coca-Cola company is going to deliver to you over the next 200 or 300 years? The discount rate doesn't make much difference as you get further out. And that is a question of how much cash they're going to give you. It isn't a question of, it isn't a question about how many analysts are going to recommend it or what the volume in the stock is or what the chart looks like or anything. It's a question of how much cash it's going to give you. That's the only reason. It's true if you're buying a farm. It's true if you're buying an apartment house. Any financial asset, oil in the ground, you're laying out cash now to get more cash back later on. And the question is How much are you going to get? When are you going to get it? And how sure are you? And when I calculate intrinsic value of a business, when we buy businesses, and whether we're buying all of a business or a little piece of a business, I always think we're buying the whole business because that's my approach to it. I look at it and say, what will come out of this business and when? And what you really like, of course, is them to be able to use the money they earn and earn higher returns on it as you go along. I mean, Berkshire has never distributed anything to its shareholders, but its ability to distribute goes up as the value of the businesses we own increases. We can compound it internally, but the real question is, Berkshire selling for, we'll say, 105 or so billion now. What can we distribute from that 100? If you're going to buy the whole company for 105 billion now, can we distribute enough cash to you soon enough to make it sensible at present interest rates to lay out that cash now? And that's what it gets down to. And if you can't answer that question, you can't buy the stock. You know, you can gamble in the stock if you want to, or your neighbors can buy it. But if you don't answer that question, and I can't answer that for internet companies, for example. There are a lot of companies, there are all kinds of companies I can't answer it for, but I just stay away from those.
You obviously have filters that you apply on selecting people as you do on stocks. Can you tell us a little bit about what those filters are?
That is a key question, because when we buy businesses, we don't have managers to put in them. I mean, we're not buying them that way. We don't have a lot of MBAs around the office that we're...
Thank God.
Yeah. That I have not promised that they're going to have all kinds of opportunities. So, as a practical matter, we need management with the businesses that we buy. And 3 times out of 4 or thereabouts, the manager is the owner and is receiving tens of millions, maybe hundreds of millions of dollars. So they don't have to work. And we have to decide in that time when we meet them whether they love the business or love money. And we're not making a moral judgment. Charlie may, but I'm not making a moral judgment about whether it's better to love the business or love money, but it's very important for me to know which of the two is the primary motivator with them. And we have had extremely good luck in identifying people who love their business. So all we have to do is avoid anything that, on our part, that diminishes that love of the business or makes other conditions so intolerable that they overcome that love of the business. And we have a number of people working for us that have no financial need to work at all, and they probably outwork 95% or more of the people in the world, and they do it because they love smacking the ball. And we virtually had no mistakes in that respect. And we have identified a number of people, Charlie and I have, in terms of proposals to us, where we felt that they liked the money better than the business. They were kind of tired of the business, and they might promise us that they would continue on and they would do it in good faith, but something would happen 6 months later, a year later, and they'd say to themselves, why am I doing this, for Berkshire Hathaway when I could be doing whatever else they want to do? I can't tell you exactly what filter it is that we put them through mentally, but I can tell you that if you've been around a while, I think you can have a pretty high batting average in coming to those conclusions, as you can about other aspects of human behavior. I'm not saying you can take 100 people and take a look at them and analyze their personalities or anything of the sort, but I think when you see the extreme cases, the ones that are going to cause you nothing but trouble or the ones that are going to bring you nothing but joy, I think you can identify those pretty well. Charlie?
Well, yeah, I think it's pretty simple. You've got integrity, intelligence and experience, and dedication. And that's what human enterprises need to run well. And we've been very lucky in getting this marvelous group of associates to work with all these years.
But we filter out a lot of people. And then they say, how do you filter them out? I would say, and I think Charlie will agree with this, people give themselves away fairly often, and maybe it does help to have been around as long as we have, in seeing the various ways they give themselves away. When somebody comes to me with a business, and I probably shouldn't tell this publicly because they'll probably tailor their approach subsequently, but when they come, just the very things they talk about, what they regard as important and not important, there are a lot of clues that come as to subsequent behavior. And like I say, we've really had a batting average I wouldn't have thought we would have had in the people that we've joined with, but it hasn't been 100%. It's been well above 90, and I get asked that, I mean, how do you make those judgments? And I don't know, Charlie, can you articulate the way we do it?
Well, partly we're deeply suspicious when the proposition is too good to be true.